Hi, I'm Alistair McCaig. I'm a market analyst here at IG. The Dow Jones is, I guess, the leading index that's referred to by many in the news industry when talking about US markets. Again, this is maybe slightly misleading. It is an index that's derived by share price as opposed to market capitalization. Obviously, the FTSE 100 is market capitalization, which is the largest companies by their total capitalization, share price multiplied by shares in issue. Whereas in America, it's actually derived on the back of the share price. There's a slightly different structure in America as opposed to the UK when it comes to share prices. They do tend to be much higher. This is really due to the tax implication, and as such, psychologically speaking, Americans are far happier trading a company that's trading at $110 as opposed to UK, where we tend to be a little bit happier trading something that might be trading at, say, £1.70 or something like that. As such, the Dow is made up of these high-priced companies, and I think when it comes to looking at the US markets and really assessing how the American economy is behaving, it is possibly better to look at the S&P 500. This will, for a start, give you a far broader spectrum of companies that it covers, and it will give you a much more accurate idea of how exactly the US economy is behaving. When you ask the question what might be riskier, trading the Dow as an index or individual equities, I guess for a start it really depends on what you're trading for and what aspects you're looking for specifically. If you want to have a reduced risk exposure, it's better to trade indices because it gives you a broader basket rather than all your eggs in one, as it were. Having said that, of course, if you're looking for specific market actions, potentially you are more likely to see that a less diluted reaction to news flow if you trade a specific company. It really depends what exactly your angle is when you come to the trading table. As far as trading guaranteed stops is concerned, it's pretty broad across the spectrum. It really is more a case, certainly here at IG, that the volumes with which business gets transacted in a product, as opposed to whether it's in, say, the DAX, the Dow Jones, the NASDAQ or the FTSE, they're very well traded products, and as such, guaranteed stops are easily done. Whereas clients who might be looking to trade in something that's a little thinner volume, such as, for instance, the AIM market in the UK, might find that there are restrictions put upon that. When it comes to trading the Dow and what strategy might be best incorporated to look at fundamentals or to look at the technicals, I guess we once again ask ourselves the questions of exactly what we're looking for and how that might be affected. So potentially, I think when it comes to fundamentals, you might be better off looking at individual equities rather than the indice, because as such the indice will have a more diluted reaction to any specific fundamental aspect. Certainly it's a question whereby the Dow has companies that again are multinational to a certain extent, so anything that might be specific to, for instance, any one region in the US might not really, you might not see the full ramifications of that work its way through to the actual underlying indice. And I guess from a technical point of view, because it's such a broadly traded indice, there is a good volume two-way on it, and as such it does make it, I guess, a good product to look at, to trade from a technical point of view. I think when looking at the major indices, the Dow, the FTSE, and the DAX, for instance, I think when we do look at the economic calendar to see exactly what news flow is coming up and where it's coming up from. And ironically enough, it certainly used to be the US news flow that really shifted the markets, the likes of non-farm payrolls, for instance, which were most keenly anticipated by traders. And certainly non-farm payrolls is still watched closely because it will have a moving effect on the US markets. But I think increasingly, as the importance of China and Asian markets have come into play over the last decade, it's ironically enough economic news flow that comes from China that is being as keenly watched as US economic data. And nowhere has this been more obviously pointed out than in last week's or earlier on this week's Chinese GDP figures. They were anticipating an 8%. It came in at 7.7, and there was an almost instant reaction across markets, whether they be in Europe, US, or in Asia.